Hey guys, Anushil here. The new financial year is almost here and you know what that means, tax planning season. Forget last-minute panic in March. Smart tax saving is a year-round game. Every rupee you save in taxes is a rupee you can invest, spend or enjoy. The government actually wants you to save. There are legal ways to keep more of your money. Today, I'll break down 7 practical, legal and simple ways to save big on your taxes for FY 2024 to 25. No jargon, just actionable advice to make your bank account happier. Grab your Notes app and let's get started. Let's start with the OG of tax saving, the granddaddy of them all, Section 80C. It's the most well-known and widely used tax-saving tool available. You can invest up to Rs 1.5 lakh and get that entire amount deducted from your taxable income each year. This can significantly reduce your tax burden. If you're in the 30% tax bracket, that's a whopping Rs 45,000 saved annually. That's a substantial amount of money back in your pocket. Enough for a brand new smartphone or even a well-deserved family trip to that dream destination. So, what are the popular investment options under this section? PPF, or Public Provident Fund, for safe government-backed long-term growth. It's a reliable and secure option. ELSS, or Equity-Linked Savings Scheme, for potentially higher market-linked returns. But remember, it comes with a 3-year lock-in period. And a pure term life insurance for comprehensive family protection in case of unforeseen circumstances. A crucial tip: don't mix insurance and investment. They serve different purposes. Stick to pure term plans for your ATC benefits when it comes to insurance. Your EPF contributions, which are automatically deducted from your salary, your kids' tuition fees for their education, and the principal component of your home loan repayment also count towards this limit. 5-year tax-saving FDs offered by banks and NSCs or national savings certificates, available at post offices, are also viable options. The real trick is to strategically align your ATC investments with your actual financial goals. Don't just dump money in at the last minute to meet the deadline. Are you primarily saving for a comfortable retirement? Then focus on PPF or EPF. Do you want potentially higher returns and are comfortable with some market risk? Then consider LSS. Is your priority protecting your family's financial future? Then definitely get a term plan. Carefully check your salary slip for existing EPF deductions, and then strategically plan the rest of your investments to comfortably hit the Rs 1.5 lakh limit. Start early in the financial year, setting up monthly SIPs in ELSS or making regular PPF deposits throughout the year works best in the long run. Don't wait for the March madness and the last-minute rush to invest. Make your money work diligently for you all year round, not just at the end of the financial year. Your future, financially secure self will definitely thank you for your proactive planning. Remember, ATC isn't just a checkbox to tick off on your tax form. It's the strong foundation upon which you build your entire tax-saving strategy and long-term financial well-being. Review your options, plan your investments strategically, and automate the process wherever possible for consistent growth. That's the smart way to win the tax game and build a secure financial future. Now that we've covered ATC, let's move on to the next big tax saver and explore its potential benefits. Alright, next up on our tax-saving journey is Section 80D, all about health insurance. This is a crucial section that can significantly reduce your tax liability while ensuring you and your family have access to quality healthcare. Medical bills, as we all know, can unexpectedly destroy your hard-earned savings in the blink of an eye. A sudden illness or accident can lead to substantial expenses. Therefore, having a comprehensive health cover is not just advisable, it's an absolute must for financial security and peace of mind. The good news is, you can claim a deduction of up to Rs 25,000 for the health insurance premium you pay for yourself, your spouse, and your children. This helps to lower your taxable income, and the benefits get even better. You can claim up to Rs 50,000 if you or your spouse are senior citizens, meaning you're over the age of 60. What if you're also paying for your parents' health insurance policy? Well, that's an additional Rs 25,000 deduction you can claim. Or, if your parents are senior citizens, that amount increases to Rs 50,000. If you max out both your family's and your parents' policies, you could potentially claim up to a total of Rs75,000 in deductions under Section 80D. That's a significant amount of real money saved on your taxes, and it comes with the invaluable peace of mind knowing you're protected. Even if your company already provides you with health insurance coverage, it's still a smart move to get a personal health insurance policy. This ensures you have better, more comprehensive coverage and allows you to claim this valuable tax benefit. What about preventive health checkups? Yes, the expenses for those are also covered. Up to Rs5,000 for preventive health checkups is included within the overall deduction limit. So, here's your action step. Review your current health insurance coverage carefully. If needed, buy a policy that adequately covers your needs, and most importantly, remember to keep all those premium payment receipts organized for tax filing. Don't think of your health insurance premium as just another expense. It's a vital investment in both your family's health and the long-term health of your financial well-being. Protect your family's health and simultaneously save money on your taxes. That's what we call a true win-win situation. Alright, let's keep this momentum going and move on to the next important topic. Next up, let's dive into the tax benefits related to rent payments. If you're salaried and pay rent, it might feel like a significant chunk of your income disappears every month. But what if I told you a portion of that rent could actually come back to you in the form of tax savings? House rent allowance, or HRA, is your friend in this situation. HRA makes a chunk of your salary tax-free, effectively reducing your overall tax burden. This is applicable if you live in a rented house. The exemption is the lowest of three components: actual HRA received, which is the amount your employer provides as part of your salary package, rent paid minus 10% of basic salary. This considers your actual rent expenditure, or 50% of basic salary if you reside in a metro city, and 40% if you live in a non-metro city. Let's illustrate with an example. Suppose your basic salary is Rs50,000, your HRA is Rs20,000, and you pay a rent of Rs22,000 in Delhi. In this scenario, you can claim Rs17,000 per month as tax-free. To claim this benefit, you need to submit valid rent receipts, and if your annual rent exceeds Rs1 lakh, you'll also need to provide your landlord's PAN details. Here's a pro tip. You can actually pay rent to your parents, even if you're living with them. Just ensure there's a proper rental agreement in place and the rent is transferred via bank transfer. You can then claim HRA, especially beneficial if your parents fall into a lower tax bracket. What if there's no HRA component in your salary? Don't worry. Section 80GG of the Income Tax Act allows you to claim a deduction for rent paid, even if you're self-employed and don't receive a formal HRA. Under Section 80GG, the deduction is the lowest of these three amounts: Rs5,000 per month, 25% of your total income, or the actual rent paid minus 10% of your income. So first, check your salary slip for an HRA component. Then, diligently collect all your rent receipts. And finally, talk to your HR department if you don't currently have HRA in your salary structure. They might be able to restructure your pay package to include it. Sometimes they can restructure your pay. Don't miss out on this powerful exemption. It can significantly reduce your tax liability. Rent is a big expense for many, so make it work for you by claiming these deductions. Keep your paperwork organized and ready for submission. Save on tax, and ultimately, stress less about your finances. Next, let's shift our focus and talk about home loans and the tax benefits they offer. Believe it or not, your house can also save you money on taxes too. Ready to learn more? Let's go ahead and dive in. It's home loan time, so let's get started. Bought a house with a loan? Congrats! Now let's save tax. The principal part of your EMI is covered under Section 80C, up to Rs15 lakh. The interest part, Section 24B, lets you claim up to Rs2 lakh per year for a self-occupied home. That's a huge deduction, especially in the early years when interest is high. If you've rented out your property, you can claim the entire interest paid, no upper limit. For first-time buyers, Section 80 EEA may offer extra deductions. Check if you qualify. To To claim, get your loan statement from the bank showing principal and interest paid. Declare these to your employer or claim when filing your return. Factor these savings into your home buying decision. They make a real difference. Your home isn't just a roof, it's a tax-saving asset. Don't leave money on the table. Let's move to the next secret weapon. NPS is up next. Want to save even more? Meet the National Pension System, NPS. Under Section 80CCD 1B, you can claim an extra Rs50,000 deduction over and above 80C. That's an extra Rs15,000 saved if you're in the 30% tax bracket. NPS is a retirement plan. Your money is invested in equity, bonds, and government securities. You choose your asset mix, and it's managed by pros. Lock-in is till age 60, but that's the point. It's for your future. Withdraw up to 60% tax-free at retirement. The rest gives you a pension. Only Tier 1 NPS accounts get the tax benefit. Open an account online, pick your fund manager, and start investing. NPS is perfect if you've maxed out 80C and want more tax savings plus retirement security. Invest Rs50,000 every year. Save tax now, build wealth for later. 2 birds, 1 stone. Let's talk about education loans next. Education loans can be a tax saver too, thanks to Section 80E. You can claim the entire interest paid on your education loan, no upper limit, for up to 8 years. This applies to loans for yourself, your spouse, kids, or even if you're a legal guardian. The loan must be from a bank or approved institution, not friends or family. Only the interest part of your EMI is eligible, not the principal. Get a statement from your bank showing interest paid. Deduct this when filing your return. It's a big relief, especially in the early years when interest is high. If you're planning higher studies, factor this benefit into your loan decision. Don't miss out. Many people forget to claim this. Education is an investment, and so is this deduction. Knowledge saves money. Now let's talk about giving back and saving tax while you do it. Want to save tax and do good? Section 80G rewards your donations to approved charities. Some donations get 100% deduction, others 50%. Check the rules for your chosen cause. Donations above Rs2000 must be made digitally, no cash. Always get a receipt with the charity's 80G registration number and your details. When you file your return, enter these details to claim your deduction. Support causes you care about, education, environment, health, and get a tax break. Do your research. Pick a credible charity and verify their 80G status. Giving back feels good and saves you money. Align your values with your finances. Everyone wins, you, the charity, and your tax bill. Let's wrap up. That's it. 7 smart legal ways to cut your tax bill this year. Pick the ones that fit your life and goals. Remember, this is for education only. Always consult a qualified tax advisor for your specific situation. Tax laws can be tricky, so get expert help. If you found this helpful, like, share, and subscribe for more Money Smart content. Drop your questions in the comments. Thanks for watching. See you next time.